Hello, everyone. Welcome to another VSG Oceanside chat. These are becoming almost weekly events for us, and we're really, really fortunate because VSG has been operating for quite some time now. This iteration of VSG, almost 5 years, and we have friends and family specialists that come in and do these things for us, pro bono, by the way. And Chris is no stranger to VSG. He has participated as a Summer Smasher speaker. He's been a 3-time VC Angel Office Hours participant, and he's an Oceanside Chat superstar. So we're super happy to have him back. A little bit about Chris. He's an experienced software engineer and project manager. He's got 17 years under his belt. He currently serves as the vice president of an engineering company called Away, which is a direct-to-consumer lifestyle brand. He's the executive committee member at Tech Coast Angels, which is part of the reason why he does VC Angel Office Hours with us. And he's a part-time instructor at UCLA in the Department of Engineering and Technology. He's also a member of the Forbes Technology Council. And honestly, he's a million other things. If you guys really want to know more about Chris and his bio, please, you can check it out in the videos that I sent out. But I'll also let Chris expand a little bit upon his skill set and why we love him so much. Thank you so much for joining us today, Chris. I'll let you take it away.
Thank you, Arcelia. Great to be back at the Oceanside chat. Obviously, welcome future innovators and entrepreneurs to the session on navigating investment landscape. So today we'll really explore the economic context, delve into some investor behavior, and spotlight sectors ripe with innovation and resilience. Together, we'll demystify the due diligence process, understand its pivotal role, and learn how to make your star shine in the eyes of investors. So again, I'm Christopher Yang. I'm here to share my insight and experience to help you seize your opportunity and navigate the challenges ahead. We'll have an interactive Q&A session at the end, but feel free to interrupt me and engage and ask questions as we go as well. And before we get into today's topic, just a really quick intro and bio about myself and my journey to date. Currently serving as VP of Engineering at Away, as Arcelia mentioned, a D2C brand. You probably recognize it for its innovative job offering. We sell suitcases. We probably sell over, I would say, 3 to 4 million suitcases thus far. We sell about 1 million of them a year on average. With nearly 2 decades in the tech sector, I've also had the privilege of leading teams at companies like Onriva, corporate travel management, DirecTV, and Ticketmaster in the past. I was also part of the journey of Onestop Internet back in the days before I joined forces with Nogin. As a member of the executive board member at TCA Tech Coast Angels, I've been involved in directing significant investment into diverse range of companies. So I provide extensive experience in conducting DD, due diligence, and have successfully spearheaded numerous deals for TCA, and also subsequently served as the board observers for various portfolio companies for TCA. My academic journey at USC has equipped me with multifaceted perspectives on both technology and business. I've got multiple degrees there, MBA, MS in industrial engineering, and also MS computer science. I'm excited to share my insight and learning with all of you today on due diligence. Before we delve into the intricacies of due diligence process, it is essential to set the stage by really discussing the current investment landscape a little bit. Why is that important? Understand the economic context, investor behavior, sector focus, and really the climate for SARB to provide a backdrop against which the due diligence process operates is very important. It helps us comprehend why certain aspects are emphasized more than others and how shift in the landscape can influence investor priorities and expectations. Its foundational knowledge will not only enrich our discussion on due diligence, but also empower startup here today to better align with investors' perspective and navigate the investment journey more effectively. So I'll start by exploring the resilience of the U.S. economy and the challenges and opportunity it represents currently. So the U.S. economy post-pandemic has been a topic of much discussions and analysis, right? It has defied many expectations, bouncing back with vigor and surprised even more optimistic by outlook. However, it is essential to look beyond the surface and understanding of the underlying currents. So, saving across households has been shrinking, and really signal a potential reduction in consumer spending. We witnessed that way as well. I mean, saving is really a cornerstone for economic stability. And the other part involves like escalating of oil costs, and which is just number at just number at gas pump, right? They ripple through the economy, affecting production costs, transportation, ultimately the prices of goods and services. So these factors, coupled with a tightening grip on banking lending, as well as the heightened of interest rate, really create a scenario when we're anticipating a recession that's coming. Moreover, the sector of high interest rate, as I mentioned earlier, is really a double-edged sword, right? On one hand, it's a tool to curb inflation, but on the other hand, it can really stifle growth, making borrowing more expensive, making capital a lot more expensive in today's environment. It's been much harder to raise capital versus prior years. So for a start, this economic backdrop is like a chessboard, right? Each move, each decision is influenced by these macroeconomic factors. Understanding them is not just about knowledge, it's about like strategy, it's about anticipating how these elements can impact your venture, your growth, and your ability to attract investments. So remember, challenges also brings opportunity, right? A cautious approach to spending and investment can lead to a more thorough evaluation of opportunities and potentially benefiting startup that can demonstrate real value and potential. It's about navigating the waters with foresight and adaptability, turning potential challenges into stepping stones for growth. So, as we delve deeper into the due diligence process, keep the economic context in mind. Again, this is a backdrop against which investors are evaluating, and this landscape that you startup is navigating. So, understanding it, adapting it, and leveraging it is the first step in standing out and secure investments. So as we navigate through the economic landscape we've discussed, right, it's pivotal to understand the mindset and behavior of current investors that you're looking to attract. In times of uncertainty, which I call investor behavior tends to shift toward caution, but it's a nuanced picture actually. Investors, especially those with experience, are well versed in cyclical nature of market, right? You always have uptime and downtime, right? Understand the volatility while presenting risk also prevail. Unique opportunity it is in current times. It is a time when true potential of startup can shine, where innovation, adaptability become the currency of value. In this climate, investors are not just seeking safe havens, just like I am, not looking for the standard return, right? They're meticulously scanning the horizon for companies that stand out, that demonstrate resilience and offer solutions to challenge of the day. It's a landscape which opportunity for those who can align their vision with the need of the market and expression of investors. Diversification become a cornerstone strategy, right? Investors are looking to balance their portfolio to mitigate risks with different opportunities. They're exploring different sectors, different stage of growth, and different business models. For startup, that means understanding not just who you are, but how you fit into this broader investment ecosystem, broader landscape. Market volatility is not a barrier, it's a testing ground. This is where your startup value proposition, your adaptability, your vision are put into test. It's an environment where the alignment of your goals and strategic interests of investors can really pave the way for a partnership down the road. So as we delve deeper into the intricacy of due diligence, remember, it's not about showcasing what you have. It's about demonstrating how you can align and evolving priorities and strategies of investors, such as diversification. I talked about value-oriented investing, ESG, or adaptability and agility of the startup. It's about building relationship, fostering trust, and building and positioning yourself as a beacon of opportunity in the seat of uncertainty. So in the dynamic investment landscape, as I mentioned earlier, there's a discernible shift toward sectors that embody innovation and resilience. Essential for startup to comprehend this shift as it shapes the investment priorities and strategies. Uh, Investors are actively exploring sectors such as AI, cybersecurity, automation, as these fields are not just buzzwords, they represent the frontier of technological advancements and have demonstrated remarkable resilience in the face of market uncertainties. So why the focus on these sectors? It's mostly because they are perceived as catalysts for change, driving efficiencies, opening new markets, and creating solutions for complex problems. The architect for the future, shaping industry, consumer behaviors, and even societal norm down the road. For AI, applications are vast and transformative, right? From Gen AI that kind of emerges more than a year ago, from automating process to enhancing decision makings and personalized experience. It's a sector that revolutionizing industry and creating value, redefining the new possibilities. Moving forward really quickly, cybersecurity is also crucially important in a world ever more connected and relying on digital platforms as being a cornerstone of trust and reliability. So it's not just about protecting data, it's about safeguarding reputation, ensuring the compliance and building consumer confidence at the same time. And then finally, automation is streamlining operation, reducing costs, enhancing productivity is more necessary in today's environment when where everyone's trying to save costs, enables business to adapt to scale and innovate, creating a competitive edge in responding to market demand with agility. So investors are not only looking for innovative solutions, they are seeking for startups that could adapt, they could navigate these challenges and really turn visions into reality. It's about balance between innovation, practically, between vision and execution. A startup in this room, I understand the focus is pivotal, right? It's about aligning your value proposition with the trends shaping the investment landscape. It's about demonstrating not just potential of your technology, but how actionable, how scalable it is, and its ability to really impact and address real world challenges. So in this competitive and cautious investment climate, right, standing out is not just an advantage, it's a necessity, right? So startup needs to showcase not only viable and potential viability and potential of their ideas, but also their adaptability, resilience, and foresight, as I mentioned earlier, and memorable, and building a compelling narrative, which is also important as part of your DD, are your ticket to securing an investment. And this brings us to the crux of our discussion today, the due diligence. So having explored the investment landscape and the imperative of standing out, right, let's delve into the heart of our discussion. Due diligence pivotal juncture in your startup journey. It's a phase where scrutiny and opportunity all walk hand in hand. So DD is a comprehensive evaluation, a meticulous examination of every facet of your startup. It's a lens through which investor view the intricacies of your business, seeking to uncover both the gem and also the grit. As a process that peels back the layers, revealing the core of what your startup is and what it has potential to become. But why is DD so pivotal? It serves as a risk assessment tool from an investor's perspective, right? A mechanism through which investors validate their potential investment. It is their way of ensuring that venture are considering that they're considering a sound, viable, and whole promise for the future growth to come. And most importantly, the return ROIs that they will receive. For startup, due diligence is a really golden opportunity at this stage. It's really served as a platform where you can showcase your strength, address concerns, and build trust beyond the initial screening, your initial pitch. It's a dialogue, a conversation where you can articulate your vision, demonstrate your commitment, and validate your propositions. Like imagine you only had about 15 minutes doing the screening, to present your idea. This is really the time that investors are willing to sit down and listen to the details, listen to you speak and talk about your team, your growth strategy, your go-to-market strategy, and etc. It is essential to approach this process with a mindset of openness and collaboration. It's not about defending flaws, but about acknowledging them and showcasing your strategy for improvement. It's about painting the realistic yet promising picture for your venture when I balance optimism with pragmatism. Remember, due diligence is much about future as it's about present. It's about showcasing your roadmap, right? Your future product roadmap, your plan for growth, and how you intend to navigate the journey ahead. It's about demonstrating that your startup is not just a brilliant idea, but a sustainable business poised for success. As we navigate through the various facets of due diligence, keep in mind that this is your narrative to shape, right? It's an opportunity to build relationship, align visions, and lay the foundation for future partnership even after this round of funding. So let's look into deeper into understanding why due diligence holds such paramount importance in investment journey. It's not really a procedure, it's a pivotal process that serves as the bedrock for future partnership and collaboration. First is risk mitigation, as we talked about. For investor, due diligence is akin to peering through magnifying glasses, scrutinizing every detail to mitigate risk. It's about identifying potential red flags, assessing the viability of the business model, and ensure that the investment is sound and secure. It's not just about identifying challenges, it's also about uncovering hidden gems and opportunities and discovering potential for innovation, scalability, and market dominance that might not be evident at the first glance. It's about building trust and alignment. Trust is the cornerstone of any successful partnership. As mentioned earlier, through due diligence, startups have the opportunity to foster trust by being transparent, addressing concerns proactively, and demonstrating the commitment and integrity. Integrity is vitally important in this case. That if we can't trust the team, it's hard to convince the investor to write those checks. Validating the proposition, value proposition, and showcasing scalability. This is a stage where your sort of propositions put into test, right? Where you get to validate uniqueness and value of what you're offering, demonstrating how it meets, how the product has a demand, has a product market fit, and really solve the problem. And it could really scale, right, as a sizable problem that could generate outsized return down the road. It's a foundation for a successful partnership. So we gain insights about relation built during due diligence by layering the foundation for future collaboration. It's about establishing a partnership that's not just transactionally based, but transformative, right? So we're here to help you for your future growth. So moving forward, a little bit turn our attention to key areas that will be meticulously examined during the DD process. These components are like different facets of diamond, each contributing to the overall brilliance of the value of your startup. So the due diligence process is comprehensive. Just dissecting various components of your startup. Think of it as assembling a puzzle where each piece is such as management, technology, strategy, and financing, users with data, all contribute to forming the complete picture of your venture. Each of these components reveal different aspects of your startup, providing insight into strength, areas of improvement, and potential for growth and success. So I'll move a little quicker into innovation and protection. So let's look at the management team first. Sorry, I skipped a slide. Yeah. The management team is leading a startup is often considered the backbone for the venture. It's a collective strength, vision, and commitment of this team, and can steer really the startup forward to success. So what we do as investors, we'll meticulously examine the backgrounds and experience of each team member. We're interested in understanding the diverse skills and knowledge, expertise in each individual bring to the table, and what you've accomplished in the past, and how does that experience contribute to the success of the startup, right? So this is where we look for seasoned executives or like serial entrepreneurs who have demonstrated success in the past. Roles and commitments, right? So the clarity of roles within the teams are similarly important, and the level of commitment from each members are vital. Investors want to see a team where each member has a clear purpose, it has to be a well-structured management team that understand their responsibilities and is fully committed to the vision and goal of that startup, right? We'll get into more of that in a little bit. Team dynamic and decision making process, I can stress how important that is. How well does the team work together? Investor will assess the dynamic of the team. I've done a couple like interviews with outside of the founder where I speak with the immediate management team at the same time separately to understand their bonding, their collaboration, their communication, and potential conflict resolution skills at the same time. A well-functioning team with effective decision-making process is a positive indicator of your startup ability to overcome challenges down the road. A shared vision, I think it's similar. We need to make sure that the executive teams share similar visions, share similar goals. Investor will look for evidence of a cohesive team that share a common vision that has resilience and adaptability to navigate through both calm and turbulent waters. Again, similarly, the team need to have balanced skill sets. With balanced skill sets and diverse skills, really is like a well-oiled machine, right? Investor will evaluate whether your team has the right mix of technical, managerial, interpersonal skills to drive innovation, right? Sometimes we look at a team and really put an asterisk right to the investment. We really need to bring someone with managerial skill set, right? You need to be able to hire a CEO or a COO before funding can be created. So this is also very important that we need to have the right balance of skill sets. Showcasing team cohesion is crucially important, right? This is really your opportunity to showcase your unity, cohesion within your team, highlight instances where your team has successfully collaborated on projects, overcome obstacles, and achieve milestones together in the past. The management team is one of the foundational pillars. I would say probably by far the most important one that we spend most time looking at. It is essential to present a unified front, demonstrating the strength and diversity of your team and convey really the collective commitment to realizing startup's vision. As we proceed, think of which qualities of your team align with the expectation of the potential investor. As we transition from the team to technology, it is important to emphasize that technological foundations of your startup is also a very crucial piece of the puzzle. It is the engine that powers your venture. It's a shield that really protects you from outside competition, and we care a whole lot about that as well. Evaluation of uniqueness and scalability, whether your tech can scale, can double, triple itself over time. We'll discuss the unique feature with you and capabilities given your startup's competitive landscape. Additionally, scalability is key, right? As I mentioned earlier, can your technology adapt and grow and meet increasing demand and evolving market needs over time? You also need to demonstrate innovation and market differentiation at this stage. This is really your stage to shine and illustrate how your innovation translate into tangible benefits and address market needs more effectively than existing solutions. Next is IP, right? This is by far one of the most important aspects. If you're have any sort of intellectual property, that's really your fortress of safeguarding your innovation. You should discuss the measure taken to protect your technology, including patents, trademarks, copyrights, or trade secrets. You should highlight any granted patents or any provisional patents, ongoing applications, showcasing your commitments to defend your tech assets. And During this phase, we'll delve deeper into the status of applications, patent applications, and any sort of regular approval necessary for your market. Specifically, if you're in the medical device and life science verticals, where FDA is required, these are vitally important. These elements underscore the viability and legality of your technology, providing reassurance to potential investor about the defensibility of your innovation. Next, we will look at the robustness and of your tech stack, right? Specifically in the field of AI, machine learning, and any sort of B2B SaaS software. We look at the robustness of your tech stack and its adaptability to future development and advancement, right? So we discuss the technology readiness for integration, expansion, adaptation to emerging trends and shift in the industry. We'll also look at future challenges on the roadmap, acknowledge any technological challenges faced and strategy employed to overcome them. You should share your roadmap for future development, illustrating how you plan to evolve the roadmap and enhance your technology to stay ahead of the curve and meet future demand. To wrap up this slide, remember your technology IP are not just asset; they are the lifeblood of your startup, right? In today's world, demonstrating their strength, uniqueness, and protection is essential in building investor confidence and showcasing long-term success. Jumping ahead a little bit, let's look at another important piece of the puzzle, which is go-to-market strategy. This is really the blueprint outlines how you plan to sell your product. Having a product obviously is important, but it's also crucial to get the product to the customers. It's about identifying who your customers are, where they are, and how you can sell them. And we're going to do a lot of assessment during the DD phase. So begin by painting a picture of the market landscape, right? Who are your competitors? We get very much details. What are their strengths and weaknesses? How does your startup differentiate itself? This sets the stage for demonstrating your competitive advantage and how you plan to carve out a market share. Identify your target, your market needs, define your target audience with precision, who they are, what are their needs and their pain points. How does your product address their needs? This is about showcasing a deeper understanding of your customer and how your solution resonates with them, right? I understand that a lot of these you might have showcased in your initial screening, right? Doing due diligence, we do a much deeper dive. Our analysts will help us look at maybe a comparative analysis with a different, I would say, market leaders to really validate some of the, I would say, information that was presented during initial screening. Detailing the initial approach to market entry, this is, again, crucial, right? You also need to outline your strategy for entering the market. Given a lot of startups we look at are at seed or pre-seed stage, right? A go-to-market strategy is vitally important. Will you start locally, then expand? Are you targeting a niche before broadening your audience? Like discussing your strategy and potential partnership you'll form, and in any sort of promotion strategy to gain traction. And on top of that, you need to also dive into your customer acquisition costs, right? And acquisition strategy, how you will attract and convert leads, discuss your sales funnel, marketing campaigns, and any unique approaches to building relationship with customers. Highlight how you plan to establish and maintain a strong presence in this market. Next, articulating the differentiation and value prop, right? This is your mode. Articulate what sets your product service apart, what's your unique value proposition, how you deliver value to your customer in a way that competitors don't, right? This is your opportunity to showcase that as well. And discuss how you will maintain and enhance your competitive edge in this current market. What are your plans for product development, innovation, and adaptation? And how you will cope with changing consumer needs, outline some of your visions for future expansion, etc. So finally, share some key metrics you track to measure the success of your go-to-market strategy and the milestone you aim to achieve. This provide investor with tangible benchmark to gauge your progress, and the effectiveness of your strategy. A well-crafted go-to-market strategy is your roadmap to success. It really demonstrates to investor that you have a clear, actionable plan to deliver your product or service to customers, and really to achieve the market dominance that you pitched. Moving forward, if you're an application or a mobile app that interface with users, I think its engagement is very important as well, and that ties back to your growth strategy. This encompasses and really guides you towards scalability, right? Market expansion and diversification, as well as long-term sustainability. It's about envisioning where you want to be and really charting the course to get there. So we talked about scalability a little bit earlier, right? So you also want to make sure you detail how your startup plans to scale, aiming for geographical expansion, diversifying your product line, or target customers. So yes, we talked about go to market, but how would you grow beyond year 1, year 2, and year 3, so we could understand a clear path to exit. And then market expansion, diversification, and roadmap we talked about, and how you could adjust to like emerging market trends as well. So moving ahead, on the engagement side, we really want to focus on user understanding, measuring user engagement and growth are pivotal in showcasing value and potential of your product and services. So demonstrating how you not only attract users, but also keep them engaged and satisfied, right? So there's a couple of things you need to be focusing on here, right? Analysis of user growth. Start by sharing the trajectory of your user growth. How rapidly has user base expanded? What milestone have you accomplished in the past, which you could use as indicators to guide your future projections? Some of the engagement metrics as well, right? Dive into like key metrics. How often do user interact with your product? What features do they use the most? Through analytics, you should be able to track that. Discuss the average session duration, daily active users, retention users, your churn rates, and stuff like that. These metrics provide insight into user behavior and product stickiness. We look at churn a lot, and in addition to CAC we talked about earlier. User feedback and satisfaction is also very key, whether you're in direct-to-consumer or B2B SaaS. You need to share insight about your reviews, testimonials, surveys, what users love about your product, where do you see rooms for improvement, whether those are on your product roadmap or not. Addressing both praises and criticisms demonstrate transparency and a commitment to continuous improvement. And we'll look at a product market fit through these data points, whether there's indication of a strong alignment between your product and market needs, and really want you to outline your strategy in terms of user retention as well. How do you keep user coming back? Discussing any loyalty program, if it's relevant to you, user community engagement, features, and any sort of more personal experience that really make your product or services sticky. And really honing on some of the acquisition growth strategy we touched on earlier, and then showcase some positive trends and testimonials that you gather from your base. Captivating your audiences about showcasing that your startup is not only attracts and retain users, but also listening, adapt, and continuously strive to enhance the user experience. All right, the next piece is actually very important as well. The financial narrative, especially in current times, where everyone's looking for profitability. The financial story is like the heartbeat of your venture, indicating its health, vitality, and potential for longevity. And given this relatively to raise capital in today's day and age. Current investor definitely look for companies that could paint a very compelling narrative. And one is it needs to be clear path to the next liquidity or of capital raising event, or clear path to profitability, so the startup can remain afloat. That's where numbers translate into insights and projections and really paint a picture of the future. So we'll do in-depth analysis of financial statements, begin by presenting a full analysis of your financial statements, break down your income statements, balance sheets, cash flow statements, and really highlight some of the key financial ratios. Your margins are crucially important, profitability margins and gross margin at the same time, and liquidity indicators that set the foundation for understanding your startup's financial health. Next is really your projection, right? Unveil your financial projections. What revenue growth, profit margin, and cash flow do you anticipate in coming years, right? And definitely you need to use your track record to prove that your future projections is trustworthy, and really how they align to your growth strategy and market trend altogether. Your burn rate, super critical. Discuss your cash flow management, your approach to cash flow management, and how do you ensure that your startup maintain liquidity, meets its financial obligations, and invest in growth opportunity at the same time, right? So you can't just remain afloat with a single digit or 10-15% growth rate, right? That's not going to be too compelling for an investor at this stage, at pre-seed and seed stage. So you want to make sure you have the right balance between like cash flow and growth. Addressing seasonality in your cash flow is also important, and how you manage periods of financial strains. Risk mitigation, any sort of financial risk in your startup you face, put together a strategy and to mitigate them. Whether it's market volatility, currency fluctuations, or changes in interest rate. More importantly, if you're in fintech, demonstrate your financial preparedness to navigate the uncertainties. And then we'll also look at KPIs. KPIs are pivotal in measuring your financial performance. Things like CAC we talk about, and also LTV, churn rate, gross margin, and some other indicators that demonstrate efficiency and sustainability of your business model. Growth and profitability strategy. How soon you can go to profitability? What's your growth rate? Do you believe that the growth rate will sustain, or it will continue to grow exponentially? How do you optimize your cost structure, enhance your revenue stream, and maximize your shareholder value? So all these questions will get asked. You need to be prepared to answer them. Share any initiative aimed at improving the operation efficiency and financial performance at this stage. Finally, the investor ROI is important by addressing the potential return on investment for investors. What's the horizon? Provide scenario for different levels of investment and how they translate into equity stakes, dividends, and capital gains. This gives investor clear perspective on financial rewards associated with the backing of your venture. So your financial story is really a testament of your startup viability and potential. It's about demonstrating financial savviness, strategic foresight, and really a commitment to delivering value to both customers and your investors. So building trust is actually quite important. There's another area I want to touch on, right? It's a lot of the trust is really created during the due diligence process, right? It's foundational in any relationship, and no difference between startup and their investors. Transparency is the key, and you need to do that through comprehensive documentations and to build that trust. So you want to start by ensuring that all necessary documents are well organized in the data room and readily available. This includes business plan, financial statements, any contracts that you might have, employee agreements, IPs such as patents, links to those patents, and any regulatory compliance documents. The ease of access of these documents speak volume about your startups and organization skills. A lot of time we also will request your existing cap table as well, so we can validate your capital structure. You need to be upfront about your challenges. I mean, I see this all the time. Doing screening, you paint a beautiful picture, but all of a sudden going to DD, a lot of like the dots are not connecting. Any discrepancy with compliance issues your startup has faced, you need to discuss them and be very upfront about them. Discuss the steps taken to address and resolve these issues. Demonstrating a proactive approach to solving problem will build confidence in your startup management and resilience. You need to make sure you maintain a high level of transparency throughout the due diligence process. Be open to answer questions, providing additional information and clarifying any uncertainties. Transparency fosters a sense of reliability and openness. Is really essential to building that trust initially. And be committed, be ethical, be compliant, be continuously improving. Discuss your initiative policies or practices implemented to uphold integrity. Again, integrity is a really key word here. We can't trust you. If we can't trust you, we can give our money and invest in you. I think that's really the fundamental, the basics, and adherence to industry standards. This commitment is a testament to your startup's value and principles. We also will look at any sort of data security and privacy. If you're in tech that manages a lot of sensitive data, detailed measure in this space to protect sensitive information and comply with data protection regulations is key. And aside that, just maintain open lines of communication and be responsive to investors' inquiries, timely and clearly as a key, right? And a lot of time, like when we ask for something, it drags on for weeks, and you kind of lose that momentum, which is not a good thing. We want to make sure that there's legal and ethical compliance. You're meeting the regulatory standards in the industry you're operating. So building trust is an ongoing process about demonstrating through actions and documentations that your startup is reliable, transparent, committed, and compliant. This foundation of trust is invaluable in fostering a successful and enduring partnership with your investors. Or toward the end, I think one big portion of the due diligence, make sure we're planning for the exit, right? So we have a clear exit strategy. Sorry, actually, I skipped another slide. There's a legal risk. I'm not going to touch too much on legal risks. Legals are inherent in any businesses. I'm just going to really touch on the high level in the interest of time. And for startup, navigating this water is crucial. Mitigating risk is not just about compliance. It's about safeguarding the future of a startup, right? So some of the potential legal risks that we look at is or like aspect of legal risk we looked at is really understanding your risk and make sure they're compliant and you're proactively managing those risks, and then seeking advice, like engage with experienced legal counsel to navigate complex legal landscape, seek advice and contracts and agreement and legal disputes. And then we talked about IP earlier. Again, you should protect your intellectual property rigorously, register your trademark, apply for patents, and safeguard your trade secrets. And maintain positive employee relationship and clarity in the employment agreement. Address any issues such as like non-compete, if you have a seasoned executive with those clauses, confidential agreements, and employee rights, etc. You got to be transparent with your investor about existing and potential legal issues, open about the legal risks involved, and consider obtaining appropriate insurance coverage for like against liability. Let's say you're selling consumer products. Make sure you get the product insurance. evaluate the type of insurance that are most relevant to your startup and operations. And mitigating legal risks is about like diligence, right? Compliance, transparency, and proactive management is about creating a secure environment where your startup can thrive and investor can have a confidence in that their investment won't be jeopardized by any unforeseen circumstances. So exit, and skip out a little bit, and so let's dive into exit strategy as well. So investor will evaluate the timeline you propose and expect return associated with each exit strategy. This part will also be covered during the DD. They're interested in understanding how realistic your plan and whether the market conditions are favorable for such exit, right? So we'll ask a lot of both qualitative and quantitative questions, and using different type of evaluation models and understanding whether some of these exit strategies make sense or not. Investor will look at market trends, comparable exits, recent liquidity events in your industry, and want to make sure that pretty much what you pitch during screening makes sense, and there's a likelihood of successful exits for similar companies. So and how your strategy align with those market dynamics. A well thought out exit strategy demonstrates foresight and preparedness. It reassures investor that you're building companies with clear direction and angle in mind, and ultimately contributing to the building of trust and confidence in your venture. So I understand we are closing on time. Instead of me going through the last two slides, I actually want to kind of give some time for questions. I think this is a good time.
Yeah, everybody who's still on the call, if you guys want to raise your hand, I will kick off with a few questions that I jotted down. Actually, we have a question from Akshay, and I'd like to prioritize our guests. So Akshay, go ahead and ask your question.
Yeah, hi, Christopher. I'm actually working with Lucas Poles as a venture scout. And one of my questions was in especially like in an angel investment group when you're making like these pre-seed seed deals. I wanted to more understand like the metric behind like valuations, especially in a very early stage company when like the valuation is very narrative based. And since you don't want to like mess up like your cap table for like future investments, I more wanted to understand like due diligence process, especially like when calculating the valuation and the investment amount in the pre-seed round, because that like if you don't do it correctly, then it could mess up your cap table in the future. So I wanted to understand the metric behind those calculations.
It really varies from company to company, industry to industry, and knowing you work with Lucas and potentially with the Pegasus Ventures as well. So I think in general, with pre-seed, we definitely want to control the valuation to a reasonable extent, right? So in current environment, I think there's definitely we're not lacking deal flow, but just like quality companies, especially at the pre-seed stage. My opinion, this is more personal opinion. We want to lock it down below 5 or even below 3, and because when you go to C stage, right, the typical valuation of a TCA company is probably around 8 to 10 million. So that kind of leaves some room for a future round in maybe 12 to 18 months. And a lot of time it's harder if it's earlier stage, like a pre-seed stage, right? I assume most of the startup today listening to this pitch of this session is probably pre-revenue, right? So it's harder to use like market multiples to justify your valuation. So it really is around your business model and some of the industry comparison. So we're betting on your likelihood of succeeding in near term, in years to come, and using that to it would back that number to understand what would be a reasonable investment amount that to give us enough return on our investments, if that makes sense. So are you looking for specific metrics?
No, just more understanding like thought process and the like due diligence for going into such an early stage venture. So that helped a lot. Just a question on a different type of tangent. I'm currently like you mentioned how like there's a biggest like fundamental trust issue between like venture capitalists, founders, or angel investors, and especially like individual angel investors like yourself and founders. And currently working on a project at IYA to like essentially like build an app that'll like thematically like connect you with an angel investor, and like essentially like it'll describe like the size of the checks that you're looking to give, what requirements you have, all that stuff, and trying to like help with the trust issues between founders. So I was wondering, like at like Techos Angels or in your other work, how do you like source startups? Is it like the typical format, like you just get a lot of emails with a bunch of pitch decks and like the analysts sort through that, or is there a unique way of sourcing deals?
As one way to, given our presence in Southern California, we're not lacking deals, but we definitely can get some help to have a more diverse pipeline. We've been seeing a lot of life science and SaaS products companies, but not so much others in different verticals. So some diversification could be helpful. We've been partnering with other, I would say, accelerators in the region as well, in terms of bringing like more mature companies to our pipeline. Because typically we only looked at post-revenue companies with traction. So I think the accelerator stage companies are a little bit early for us. So a lot of time we keep in contact with them, and when they have demonstrated significant progress or traction, they will reach back to us, and we'll bring them into our pipeline. Other than that, we've been leveraging on our brand and our presence in our network and our presence in the area. So we've been getting quite a number of deals coming through online for our pipelines. But definitely we could benefit from more deal flows.
Great question, Akshay. And your valuation questions are ones that come up very often. It's such a sentimental space, and it's hard. I know you're desperate for some hard metrics. So are the startups. So are the investors. Everybody wants something to kind of point them in the right direction. I have a question based off of one of the earlier slides that you had mentioned about adaptability and how it's an important facet of a team. And in the interest of some of our teams at the garage, and for future teams, because we are going to have a space cohort coming in, and we probably will see more hardware teams. And as you know, those teams are longer lead times and lacking in adaptability just because they're building hardware technology. So how can teams in the hardware space seem more adaptable to investors? Where's their wiggle room in your experience? Or do you guys just stay away from hardware technologies in general because it doesn't fit the criteria?
We invest in like solar panel, or battery companies in the past, right? So this definitely, I mean, TC is industry agnostic. We invest in a wide variety of sectors. So with hardware, I guess when I say adaptability, is more around the adaptability of business model and the willingness for the founders and team to change based on headwinds or like turbulence in market conditions. So it's not so much about the change with the physical product or goods or services as much, right? So I think the hardware obviously is slightly different and software. The ability to turn around with and pretty much a newer product within the product development life cycles is definitely longer, right? So I think we definitely put that into considerations. And you really can't like do a one-to-one comparison because every industry, every product is a little different. And definitely there's nowadays there's trends moving to more of a hardware software model as well, so you could reap the benefit of the software as service in terms of high margin and subscription based model, but at the same time you'll be able to log into some of the your existing user and become a lot more sticky. So I wouldn't do a direct comparison with software, but I think as long as the founding teams are receptive, are willing to adapt and change its product lifecycle based on the competition in the market, and it has demonstrated that, and they've proven that they've been experts in those areas in the hardware vertical. I don't see any reason why we can invest in hardware companies. Obviously, the multiples are market multiples are different, so we need to really assess whether the valuations is good or not. I mean, that's more of a valuation question. Yeah, I hope I answered your question.
Yeah. Another question is kind of just some strategic advising. What are some techniques for market research that you could suggest for teams when they're developing a compelling business case for their product? I know some of our teams in this space, when they're putting their pitch together, they struggle with really kind of gathering the right type of information and knowing exactly how to address that. Do you have any advice on that?
This is my opinion, right? I would imagine the teams shouldn't struggle too much with market research, right? Because during the initial, I would say, conception phase, that the team should have known their space pretty well, and most likely they are coming up the innovative solutions or product offering because there's a gap that needs to be filled within the current vertical, the current marketplace, right? So they should know their players pretty well. And really to hone in on something analysis, I would definitely go out with market research. I think there are definitely multiple places where you can look at trends and studies, and then market share. Pitch book will be a more expensive one, but I think there are definitely I would say less expensive resources available through USC library. So that's just what that would be a place where I recommend. But other than that, a lot of this is you got to know your market, right? You got to talk to your customers. For word of mouth, you should know what other players, what other product, what other offerings they're using, and then from there you could delve into it and then do more assessments and research from there.
Great, thank you. We have a question in the chat. It was a direct question. How can one become a member of the TechHost Angel Investor Network?
Well, you could go to our official website, techhostangels.com, and apply. Depends on your geography. If you're in the USC neighborhood, I imagine you apply to the LA network. I think we go through screening, we talk to you, make sure you're a right fit, because we'll try to make sure that this is I would say closely put together network of people who have expertise and skill sets and very diverse very diverse industries. So it's important. It's obviously it's good that you bring the cash, the money to the startup community, but at the same time, we want to make sure that you can mentor, you can bring add a value add to the equation.
Great. We are at time. Unless anyone has any additional questions for Chris, we're going to wrap up. I want to thank you so much, Chris, for coming and talking with us. And I think you mentioned that you don't mind sharing your pitch deck. And so I will be able to add that to the video that goes out to everyone who's participated today. I just also want to mention that we have another Oceanside chat coming up on the 4th, which is that next week already? Oh my gosh. And it's on pitch decks that raise with Jonah. This is a second time that he's coming in and doing that. It's also an excellent time. I'll be in touch to you, Chris, for our next VC Angel office hours. I love having you join us for those. And thank you. I mean, do you have any final words, maybe just some piece of motivational advice for teams who really struggle with the investment landscape as it is now? Anything you can say to kind of give them a little pep in their step?
I would say be optimistic, right? This is actually a very interesting time. We're going through another wave of, I would say, dot-com phase in the 2000. With AI, obviously AI is touching all industry and all verticals, right? Most likely it's touching your startup in some shape or form. So be definitely willing to think outside the box, and the capital is definitely there waiting for the most innovative and disruptive technology or business model. And so I think this is a very interesting time. People are still writing checks, are still investing in startups, and actually more shifting toward the earlier stage where you see a 5 to 7 years of, like, I would say, exit windows versus late stage startup in the C or D or beyond, where the valuation has dropped significantly and there's really no like really no sight that this is that the interest rate will come down, and then the environments for any liquidity event is in sight. So I think that actually makes pre-seed and seed investment a lot more I would say attractive in current environment. So definitely a very, very positive sign.
Thank you. Okay, guys, we will hopefully see all of you next week for our next Oceanside chat. And hopefully, Chris, I'll see you for the next VC Angel office hours. Bye, everyone.
Bye, everyone.